Good evening. This is Doc Severson for the TheoTrade report for Tuesday, October 31st. Markets had a slight positive bias today, and most of this, from what I can tell, was due to Intel being named as the prime vendor for some of the forward iPhones that are going to be produced by Apple. And in doing so, was going to be booting out Qualcomm from some of those chips. So if we look across here at Intel, so Intel jumped up from 44.4 up to well over a point above that, about 1.2 points up, and as a huge part of the Dow and the S&P, so this definitely drove things up. Well, if we look at Qualcomm, exactly the opposite occurred from this. So it jumped from 55 down to closing at 51, but didn't have that much of an impact across the board since Qualcomm doesn't carry that much of capital exposure. Now, tomorrow we have two pretty big things happening. First of all, around 2 p.m. Eastern Time, what we have is the Fed announcement for November. Now, not many people are expecting much out of this. In fact, if we go out to the CME group, we're seeing that for tomorrow, so tomorrow's announcement, there's a 99.5% chance that nothing is going to occur and we're going to remain at the same interest rates going forward. However, when we look out to 13 December, and notice here that this is 100 to 125 basis points. When we move out to 13 December's meeting, in 6 weeks, we can see that the chances of staying at the current rate of 100 to 125 basis points is 2.3%. So the market is putting heavy weighting on Janet Yellen's last meeting as one where she raises rates another quarter point to finally finish out the year and probably her tenure. So we will typically have the market showing normal behavior tomorrow up until the 2 p.m. Eastern Time announcement, where the market holds its collective breath and waits for the smoke to come outside of the chimney to determine where things are going to go from there. I don't think we're going to see much in terms of actual policy. However, the statement that is issued is going to be what is parsed immediately by the market. The second thing that occurs tomorrow is going to be right at the closing bell, and this is where we get Facebook earnings here at the closing bell. So usually these do come out. The big tech stocks typically will come out, just like the banks do in the morning. The big tech stocks usually come out with earnings just a few seconds after the 4 p.m. Eastern closing bell. So if tomorrow operates like a normal day, we'll get a little bit of volatility in the morning. We'll get a whole lot of nothing through the lunch hour, holding their breath, waiting for the Fed announcement. We'll get some volatility coming out of that, not expecting a tremendous amount unless, of course, Yellen and the crew offer some kind of verbiage that nobody expects. And then, of course, we're going to start to anticipate Facebook earnings right at the 4 p.m. closing bell. And the fun doesn't stop there. I mean, tomorrow alone, there's 388 companies reporting. On Thursday, 593. And what happens on Thursday is Apple after the bell. So another big week of earnings. And after this one, things start to tail down for the third quarter earnings confessional. Now, the next section I want to talk about here is just in terms of ATR. So this is good old Wells Wilder average true range. And what this typically will show is that on quiet and trending markets, we typically have very low range for the day. And during corrective markets, we have much higher range for the day. However, what we're seeing right now is some of the lowest ATR in the month of October that we have seen ever. I mean, it goes all the way back here to 2011 was the last time, the beginning of 2011 was the last time that we saw ATR this low. Notice that every time, and I'm going to use the word relative here, every time that we have a relative low. So in other words, the relative low back here in 2011, which led to volatility coming in 2011, was much lower than perhaps the relative low that was in 2015, where the ATR was a little bit higher during that period. But again, it's the relative lows that we want to look at. So the relative lows for this period of time led to lows which means low volatility, range contraction leads to range expansion every time. And so we're seeing a relative low right now in the mid of October, which is extraordinarily low. And without fail, when we have this low level of ATR, or average true range, that's usually followed by a larger range. And now that I expand this, you can start to see what I'm talking about. Okay, this period of time from September's breakout, so September's breakout above here, where we started to move here, this daily range, especially as we got into the middle part of October, was just extraordinarily low, to the point where there was no fear whatsoever in the market. You can see, however, that we've disturbed this area. It's almost like we came upon a pond in the middle of nowhere that had absolutely no wind. So you come upon this pond in the middle of a hike and there's not a ripple. It's like a piece of glass. And so, of course, what you have to do is pick up a pebble and try to skip it across. Well, those ripples that are going to happen in there usually will go on for quite some time. So we've seen a little bit of energy get into the market right now. We are starting to see the true range start to expand, and this is what I'm looking for potentially coming up here soon, is that these ripples will start to expand, and we might see that corrective action that we've been waiting for oh so long, which might be just setting up with a larger range. Again, to understand this point, I'm going to unzoom this here, and you can see that when we have relative lows here, this is where we start to see corrective action. Again, I'm not calling for a crash. I don't think that we're going to be crashing at this level, but I think from relative lows, this is where we do see the price pull into more corrective action from relative lows, and trust me on this one, since we really haven't seen anything of a pullback over the course of the last year, anything that we see to the downside is going to be amplified, exaggerated. People are not used to this. They will not know how to act nor how to protect their risk. I'll finish out today's video by talking about Caterpillar. Now, if you go back to the 24th, so on October 24th, I did a segment that talked about how do you step in front of the freight train? How do you actually create short delta positions against these monsters like Caterpillar? Well, first of all, I would say you don't. Try to trade in the direction of the trend. But if you do see a reaction that where you say, look, this is just crazy town here, this is just nuts, where we see triple exhaustion across the board. So we see triple exhaustion across the board, which we've seen on more than one large cap stock as well as indices, right? This is where we have the probabilities in our favor to not necessarily short the stock. I think this is one of the reasons why we get these parabolic moves like this, is because the short interest gets high and it just gets squeezed out, especially off of pullbacks. Right? But when we get into a situation like this where we have extremely low volatility, what can we do to perhaps gain some alpha to the downside? So that's what I talk about on the 24th. I went over 3 different strategies that you can use for those. So let's kind of check in with how we're doing on those. Now, one of the trades that I did take was actually the ratio butterflies. We did a class on ratio butterflies a couple of months ago. Don Kaufman did. And so this was a good choice for this trade because it was a higher probability trade. It gave us some room above where we entered with the current price, even though I did talk about how this area in here is unlikely to produce a profit that matches what the butterfly is. So let's be realistic there. Okay, so defined risk and also gives us a fair amount of time. And of course, no downside risk to this trade whatsoever. That's obviously important. So this trade's working out fine. I think the only downside to a trade like this, and this is really sort of like with any butterfly, is that you've got 3 legs, you've got 50% more commissions versus just a normal vertical spread. Actually, a little bit more than that, since you're selling double at the center strike And the other issue is just getting fills. So getting in and getting out can sometimes be a little bit more difficult than a simple vertical spread. So let's kill that one. Let's take a look at some of the other ones that we did. So some of the other ones that we talked about is the expected move vertical spread. So the expected move vertical spread was, we looked at the option chain and we said, hey, the expected move into November, 17 November, is about 6 points. And that could be plus or minus 6 points. So that gave us a target down here at about 132 or so. Now, the issue with this one is that this is great. It's certainly profitable right now, but not that profitable because that expected move, the price really has to move for you to do well on these out of the money target vertical spreads. So the attractiveness is that for small accounts, these are great because you can buy these, as you can see, for like a 14-cent debit, 14 bucks per contract. Anybody can trade those. However, your probability is very low. So the last option, and probably the best one across the board here, is the simple in-out vertical spread. So this one, again, was where we enter this, and the spread is basically one option in, one option out of the money. And we got into this for a 45-cent debit, or per contract, that's 45 bucks. And right now, this one is up more than 50%. So more than 50%, which would be a good place to start looking at perhaps taking profits on this. So you didn't have to get that much movement on this one for it to work. So again, this is why we typically start people out with in-out spreads like this. They're simple to manage. They do require a little bit more capital, but for a $1 wide spread, 45 cents, that's not bad. I mean, most people can even handle the 45 cents versus the 14. And then if you want to get, more esoteric with the spread, then you can look at doing the ratio butterfly, which has got its own advantages to it, which of course comes with a credit. So you get a credit right off the bat. Remember those old wistful days of selling iron condors. They will be back again someday. But in the meantime, you can set up things like the ratio butterfly spread here. That is it for today's report. Thanks for listening, folks. We'll see you tomorrow.